showing you how we're really just playing a real life game of Monopoly. You know, we're not just putting money in and letting it go around and collect and go. We're trying to have that money go out into the workforce. Your own private banking system cannot be done with a traditional bank because they want to make the spread. They don't want to give the spread up. If you're going to be a bank, eliminate the banks. We use specially designed and engineered whole life insurance from a mutually owned company that pays dividends. We use giant mutually owned insurance companies because they're not banks. What's going on, everybody? Welcome back to another week, another wealth webinar, and we are going to talk about the cool down, not the cool down that's happening outside, but the cool down that's going to happen to the stock market. The other day, we saw a little sign of that, but yet it's right back to where it is. And, you know, this charade is going to continue in the markets until the election, or maybe even a little bit after the election. It always seems to follow the same path, but then all of a sudden, the winter season kicks in, and that's exactly what I'm talking about. The market's cooling down. We're going to talk about how this slowdown in the market, what we're about to have happen, actually might be a really good thing because it's going to provide a lot of much needed opportunities when it comes to prices on things like cars, houses, all of the different stuff that you would do to invest. So with that, I just want to make sure when we are playing the game of Monopoly, I kind of drew it, we're going to play this today, but when we're playing the game of Monopoly, we understand the rules of engagement. We understand how you can change the operations of your game so that you have a better probability of winning. I'm going to show you how to do that. And I'm going to bring it all back to what all of you should be doing already. But if you're not, we're going to find out, and we're going to help you become your own bank. Because you know what? Monopoly would have been way better if you were your own bank and you didn't have to take mortgages and all that stuff. So that's how it's going to work. You're still going to take mortgages, but you're going to pay them back to yourself so you leak no money in your family. With that being said, how many new folks? Anyone new here today? This is your first time on Wealth Webinar. If you're here for the very first time, put I in the chat right now. Let's just see if we got any newcomers. We got Chris Snow's brand new. Oh, wow, got a bunch. All right, welcome everybody. Welcome, welcome, welcome. So we've got Chris, we got Michelle, we got Jerome, we got Teresa coming in pretty fast. Alex, Antonio, if I didn't miss anybody. Hello, everybody. All right, so you're all here for the first time, and you know, people make it to this webinar all sorts of ways. They either make it in by Stephen and I doing What the F Happened. We did that this morning. Pretty fun, What the F. And then also you might have found it just through YouTube or various other sources, but I'm glad you're all here, and I hope you get a lot out of this. Now, here's the thing, like, can you imagine Monopoly? Remember when we used to play Monopoly as kids and we went around the board? And every time you pass go, what happened? Put it in the chat. You got a check, right? You got $200 every time you passed go. How about in real life? Is that how it works? Every time you go around the block, do you collect a check? Nope. Well, actually you do, at least some of you do, but we're going to talk about how Go and that $200 on the Monopoly boardroom really can be real life stuff. Now, let me ask you this. Did anyone play Monopoly where all they did is start going around the board just in a race to capture that $200 for pass and go? Which means you avoided jail twice, you went over all the opportunities, the railroads, you went over all that good stuff found in Monopoly. How many of you played Monopoly that way? You were just rolling the biggest numbers you could get around the board to collect the $200. Stephen, is that what you did?
That's right.
So you played Monopoly just going around the board as fast as you could to collect $200?
No, but the first time I played with my son, you know, he was trying to do that. And I just, whoa, hold on, we got to buy some of this stuff. And he caught on pretty good, man.
I like that. I like that. So that's the thing. Like, we went around trying to get properties, buy land, and put up houses and then apartments, and I can't remember them all, but like, it was so fun. And you would just stack them. And the cheaper properties, you always, you know, sometimes you'd have the problems. The game was wicked, but in real life, we're playing the same darn game. The problem is, in real life, it seems like 95% of everyone you ever come across is playing the game like your son. They're just trying to race around the game. They're literally going through life, racing through it, trying to collect $200. Now, what is that $200? Well, that could be, it could be a check from the government, which is usually not a good sign. That $200 could be, I don't know, alimony. It could be all sorts of things, but that's not how the game is played. That's not what we're all after. So we got to realize the name of the game is to strategize and think through, how do you get around the board, collect your $200 still. You don't ever want to give up the $200, avoid jail, and never miss an opportunity to buy a property when it's priced right. And part of what I'm talking about there is going to come right to you. You're not even going to have to work at this, because the markets, when we slow down, when the economy softens, which I know if you watch the news right now, it just seems like the markets are going to go up, up, and up. And I bet you a lot of folks that watch this show or any of my other stuff are just like, that Chris guy's been getting it wrong forever. Does he ever get it right? Well, sometimes in life, well, Babe Ruth, perfect example. How many times did that man swing for the fences and strike out, and then he hit home runs and become famous for it, right? So in this game of money, the name of the game isn't like, can he ever get it right? Really, all you got to do is get it right one time. I've had it right the whole time, but you can't fight the Fed, and you can't predict the markets, and you can't time the markets. And that's been the issue, because the Fed, well, doing all sorts of crazy things like printing lots of money, doing crazy things with interest rates. Listen, so be it. Eventually, the tide goes out, and that's about to happen. Historically, if you look at everything that's happening right here, right now, and you look at what's about to happen with this election, the only probable outcome after the election is slow down. I don't care who wins. So that's going to present amazing opportunities. As things slow down, just think of it like, I'll give you an example. Right now, I think most of you know this, but right now, cars cost less than they did a year ago. So especially the used car market, it's softening. All those things that during COVID, were exorbitant and just kept going up and up and up. Now the trend, they're all slowing down. I know this. I follow cars, and I look at the same cars from a year ago. They're less today. They're going down in value. Not saying it's at a buy price right yet, but that's just cars. How about houses? Certain parts of the country, we are seeing homes slow down. I know right now we have a property for sale, and it's a no-brainer. If I had listed it in the spring or last year, the house would have lasted a day, but it's still on the market. We have a registered offer, but it's just going very slow. Everything is going to do that. Now, there's a couple things that are already happening, but you're not seeing it. Well, you are, but you're not. And that is, less people are getting hired. More people are unemployed now than they were a year ago. And that trend is continuing. The job numbers that you see on the news, they're padded with government jobs. The government is plowing people, putting people to work. Hey, that's great. But it's just one industry. It's just the government hiring people. And I don't know if you know this, but that's not always the best kind of a job. So if the government is padding the jobs reports, what's really going on out there? Is the market really going up, up, and up? No, it's actually going the opposite way. When the markets go the opposite way and everything slows down, people buy less stuff. When people buy less stuff, the price comes down to meet the demand, and it just continues to fall until people start buying. A couple things stimulate that. The government stimulates it with printing money, with interest rates, but all of it plays into the same thing. It's levers. It's just levers. You need your levers. So let's just talk about the game of Monopoly. You go around the board every time you collect $200 for pass and go. Let's compare that to your own private banking system. Okay? Your own private banking system cannot be done with a traditional bank because they want to make the spread. They don't want to give the spread up. Plus, traditional banks just are not set to operate the way you need them to operate for your private bank. You're partnering with your competition, and that's not usually a good thing. So if you're going to be a bank, eliminate the banks. So what we do is we use specially designed and engineered whole life insurance from a mutually owned company that pays dividends. We use giant mutually owned insurance companies because they're not banks. They don't follow the same rules. They don't have the same principles. They don't invest money the same way. They're completely different, but that different makes them the strongest financial institutions there is. So if we change where our money goes first, we put it into the policy, we're already better off, says some, than traditional banks because we're less risk. Our money is making a much better return because an insurance company just pays more and they pay differently than a bank does. Every time the Fed drops interest rates, you get a decrease in your interest rate. In a life insurance company, they make contractual guarantees that your interest rate from day one, call it 3.25%. I'm just going to put some numbers on the screen. 3.25%. What is that number? That is a contractual guaranteed interest rate that one of the insurance companies that we use pays. 3.25%. Now, that'd be the same as your bank telling you, hey, we're going to pay you 3.25% on your savings. And that 3.25 is never going to change. It's always going to be 3.25% guaranteed for the rest of your life. So if everybody else goes to zero, you're still getting 3.25. Cool, right? And then they just say, hey, just like a credit union does, they say, hey, we love you being a member, a policy owner. So every single year, we're going to allow you to share in the profits of the company. Because listen, as an owner of the company, you should probably know this. You know, the premiums that we collect for people for those term policies and all those insurance policies, we overcharge them. So what we do is we just protect ourselves, overcharge for the life insurance because, hey, listen, we want to make sure we're protecting the downside. And then if we don't use all this extra premium that we collected, we're just going to give it back. But since we don't have any stockholders and we just have policyholders, we're going to give it back to you in the form of a dividend. But because the dividend we're going to give back to you is not technically profits, it's a return of unused premiums. Well, by IRS definition, guess what? It's free. No taxes. I shouldn't say free, but no tax. It's a return of the premium you already paid. So, hey, welcome to the family. You're now a member. And with dividends and interest, you're going to be pushing anywhere between 5.5 and 6.2%, depending on the company that we use. Way better than the bank. But here's the other thing too is, you know, when you do this with the policy, that's not the only reason to use it. When you go around Monopoly, the person that wins, well, technically the person that would win every single time, I think, is the person that had the most amount of money from the second they rolled the dice. Like if one of the players had like triple the amount of money when they rolled the dice, that person would be able to go out there. They would race to get the best properties, the railroads, boardwalk, Park Place, if you think those are the best. They would race around and buy up the whole board because they had the capital and they didn't need the time anymore. So that's another thing. Like if you've got the capital, you win the game here. So as you go around the board and you want to buy stuff, this is going to help you making a higher return because you're making more money. Your money's going to grow faster. But the other thing is, let's just say here, I don't know, you want to buy this property. I can't remember the names of them, but you're going to buy this one right here. This is your first purchase. Baltic and Mediterranean, nice. Mediterranean, we're going to buy Mediterranean, but we're not going to pay for it with cash from the bank. We're going to pay for it with cash from our banking policy. So now when we pay for this, do you remember how much that one was? 50 bucks? Yeah, we're going to buy this for 50 bucks. So once we buy it, our policy is still making interest and dividends on the 50 bucks. Because when you take money out of the policy, you're taking out money, but it's not your money. It's the insurance company advancing you part of the death benefit. So by them advancing you part of the death benefit, your money, let's just in this case say it's 50 bucks for the sake of argument, 50 bucks is still in the policy earning the dividends and the guaranteed interest uninterrupted. The only thing in the middle is when we took money from our bank, the insurance company charged us an interest rate. And this just so happens to be the interest rate as of today, depending on the series. So full disclaimer, the interest rates will change and can change by your series of contract. But 5.2 is one of them right now. So 5.2 minus 6.2, what are you making? Spread, right? If that was the numbers, you'd be making a spread. Because that would be a 1% spread. How does a bank make money? Let's say they pay you 3 and they loan that out to somebody else at 4. They make a 1% spread. Same thing, right? So this is why we use the policies. We're able to earn an interest rate that's greater than the cost of borrowing. I don't know many people out there that wouldn't borrow money at 3 and lend it out at 6. I don't know anybody that wouldn't borrow money at 3% and lend it out at 12. I mean, well, here, actually, let me not make assumptions here. We got enough people on here, well over 100 people. How many of you, and just do this with an eye, how many of you think it would be smart to be able to borrow money at 3% and lend it out at 12%? How many of you think that would be smart? Okay. All right. How many of you would do that if it was 5% and 12%. Would anyone still do it? Would that still be a decent spread? You know, we could play this game all day long, but listen, like, I don't know if I've got 103 people saying aye, but my thing to that is, well, why aren't you? That would be my thing I'd ask. Why are you not doing this? I want to show you something. Let's do this. Let's have some fun with this. The game of Monopoly, 12%. That's the number. Okay. So we want to earn 12%, and we want to borrow at a cheaper rate. Okay. All right. Let's do this. Share my screen real quick, folks. For all of you that are brand new, what I'm going to share with you is just one of the illustrations from one of the companies we deal with. And we're going to do some simple math. So I got to grab my calculator here. But I want you to understand that, like, every one of you just said you would do something, and I'm going to show you exactly how you could be doing that without taking any risk, for that matter. I mean, you're the only risk. Let's just say, I can't say you're not taking any risk, because I have to view some of you, maybe all of you, as a risk. Because I don't know if you're actually going to be your own bank. I don't know if you're actually going to follow the rules of being your own bank. So I used to say every one of you could do this, but now I'm going to say every one of you that just do what we teach, you could do this. Stephen, all we're trying to do is just find a way to get these folks to be able to make the biggest spread possible. But it'd be cool if we could show them how to make a spread, but every year they make a little bit more, because I'd have to believe a bank does that too. Like every year the bank tries to make a little bit more money off of you in different ways. So let's do what a bank does. Let's be the bank and try to do that. So the best way I know to do that is if I could borrow money at a lower rate than what I earn on that money. So let's do that math. Here is a policy. Now, I know I'm using a big one. We'll use a small one next if you want. I'm using a big one, but this person, and folks, don't get hung up in the numbers. It would work the same if we dropped some zeros, but this person dumped in $1 million in the first year. They had $1 million in the bank. They dumped in $1 million. And then this person every year said, I want the ability to save $100,000 a year. Okay, so year one, they dumped $1 million in. They moved it from their traditional bank into their policy. And every year they wanted to save an additional $100,000. That's all they're doing. And I know sometimes people just disconnect because they're big numbers, but listen, the reason we do this is simple mathematics. I don't need to get complicated. So it's a perfect example. Let's go down here. In the first year, the person puts $1 million in, they can take 917 out. It's almost 92% of what they put in, they have access. But year two, Stephen, here's where I'm going to need some math help. Right. The person puts 100,000 in, but the person has the ability to take 107,219 out. So isn't that $7,219 more than what they put in that year?
Yes.
What kind of a return would it take for your money to do that? So, wouldn't it be 7.2%?
7% return, yeah.
Yeah, so if I put 100 in and my money grew to 107,219, what kind of a return must I have received to have my money do that?
7.21.
Yeah. All right, so let's just do some math. I made 7.2% net. We just did the math. Oh, but I didn't show you how to do the math. So it's pretty simple. We put 100 in, we have 107. So if you subtract 107,219 from 100, and I know I'm discounting it $2, but 107 minus 100, you get $7,000, okay? So if you made $7,000, that would have taken 7% to make that happen, right? Yeah, it would have. Now that year, since we made 7.2, how much could we use the money in this policy for? Well, let's say it was 5.2. One of the companies we have right now, the borrow rate is 5.2. 7.2 minus 5.2 is what? 2%. Not bad. I made a 2% spread internally. Okay, so let's do the next one, Stephen. Let's go year 2 to 3. So year 2 to 3, we want to see how it grew. So if we were to come over here to the cash value, can you do some math for me? And I already did it. I just want to show them where the math comes from. Can you do $1,138,055 minus $1,024,789? Is this what you come up with?
Yes.
Okay. So the difference between year 2 and year 3 is 113,000. Now, how much did my money make? Well, I put 100 in that year. Okay. So I put 100 in year 3. And that 100 at the end of the year grows to 113. So that is a what return? 13.2%, right?
Yep.
Okay, so 13.2 minus 5.2. Now we're at 11%. We only went 1 year. We do the next year and did the same math. Here it is. You made 19,000. So what would that be? 19.6 minus 5.2. Is that better than 11? It is. Every year we play this game, that's what's going to happen. Some people are going to be like, wait, Chris, you got to add up all the amounts. And I'm like, no, 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 no. Actually, hold on. If you're doing it the way we talk, 'cause remember I said the only way it's going to look like what I'm showing you is if you do it the way we teach it. How we teach would be the first year, we're playing Monopoly, remember? We got $1 million to start. Actually, we have 917 liquid and available. So we go down and we buy Mediterranean place. What was the other one? Baltic. We buy both those. Then we land on a railroad and we buy a railroad. So each one of those things starts producing money. So we took the 917,000 out of our bank and we bought the properties on Monopoly. We bought the railroads on Monopoly. Sorry, I can't draw a railroad. But that money was out working for us. And what happens when you own a property on Monopoly, James, and somebody lands on your property?
They have to pay you rent.
They have to pay you rent. So if somebody paid you rent, where would you put the money that they paid you?
I have to pay to my bank.
In your bank, not their bank, your policy, right? So these properties you buy in Monopoly earn rent, and we're going to take that rent, we're just going to add that rent back to this number, to the policy. We're going to add that money back into the cash value of the policy. But how are we going to do that? As a loan repayment. So remember those numbers I was showing how they went up? And I know I'm doing this long form, but now we've got $917,000 of real estate that we bought that is producing rent that is coming back. So we're making money on the real estate. So that's cash register 1, but we already started doing the math on the next one, didn't we? Remember 7.2 minus 5.2, because to use that 917, to use this 107, to use this 113, we're going to take loans. Because remember, we're creating a banking system, and I don't know the last time I went into a bank and they gave me money when they didn't call it a loan. So we're always taking loans, and our loans always have a cost because the insurance company, kind of like a bank, they are not nonprofit. Therefore, they do make money. So they charge interest on that money right now, 5.2. Okay, that's what they're charging. Simple interest. But how much did we make? 7.2. So we're ahead of the game. Here we made 13. We're ahead of the game. Every single time we have money, we're going around Monopoly and we're buying more stuff. Listen, this is the game of Monopoly, but it's your life. Every time you run into more money, every time your investments earn more money, what is it that you do? You buy more investments, don't you? In your 401k, every time you put a contribution into your 401k, what do you do with that contribution? You buy more mutual fund shares. You buy more investments. You do it every day. If you're a real estate investor, what are you doing? You're going out and buying real estate. If you're somebody that just has money in a self-directed IRA, what are you doing? You're going out and lending money as many times as you can. Why? Well, because it'd be stupid not to. And because you make money. But now you're making money twice. You're making money in this case on the rent or the interest charged on the loans you make or anything you do, and you're making the spread. I go around the country speaking about this on so many stages, and I often stand up there, I do my 90-minute dog and pony, my presentation. People love it. Like we did this one event in Arizona, and we had a staff there, a full staff. They couldn't even keep up. It was hundreds of leads, or I shouldn't say hundreds, well over 100 leads from one event. So clearly they understood it. But sometimes I'm like, you know what? I really only need 30 minutes because what I just showed you here on this whiteboard is really, if that didn't make sense to you, this isn't probably for you. And the other thing too that goes along with this, like not only are we making money twice on just about everything that we do instead of making money once like we do today, we are protected because if this person here died, their family, their little kids, their husband or wife, you know, all the relatives, the ones they loved, including their kitty cats and little puppy dogs and maybe Tweety birds in there too, they all appreciate a $13.5 million death benefit. Listen, Tweety bird will always take more food. The dog and cat, well, you feed it, it'll eat it. So all of that takes money. And you ain't here to produce it anymore because you kick the bucket. Now the death benefit comes in. I'm sorry, your bank account doesn't do that. And also, I didn't mention that all this growth, that 7,000 in growth, that 13,000 in growth, that 19,000 in growth, you realize that growth was tax-free. So if you had money in your bank and a CD and a brokerage account, non-qualified brokerage, you would have to earn way more than 7%. You'd have to earn way more than 13% because you got to net it out for taxes. So again, there's a calculator you can find if you Google it, but it's called the the tax equivalent yield. Okay, you can just type that in, and it will tell you if you're in 7.2% tax-free, based on your tax bracket, you're going to pay, you're going to have to make probably 7.5%, almost 8% to make the same thing as we made in a tax-free account. So you're actually making more, and it's all protected in most states against judgments and liens. I mean, it starts to get to the point where it's just like, why does it take us an hour and a half to teach people what they should already logically say, yeah, duh, why am I not doing this? And someone said, Nick said, Chris, go over the example of, you say took 500,000 from a policy. Steven, do you have another illustration maybe you could pull up? Let's do a couple of these examples real quick. I'm going to pull one up while you pull one up, and we're just going to show you, like, and you will all see, yes, the numbers will float slightly differently, but not very much. And I think this will just be a cool exercise, because then the people watching, especially the new folks, will kind of see it a few times, and they'll start to realize we're not just using one specific illustration because it looks really good, because it will be that way with everyone. Perfect. You want to just walk them through this? So it's kind of saying the same thing, just different numbers, and I'm going to pull up another one too. We'll do 3.
So this was a real estate investor out in Oregon State. This was a female, 40 years old, 41 years old. And she had some extra cash, so wanted to do the dump in similar to the last policy. And if you're new here, what that means is when you start a policy with us, we're going to talk to you about what your financial situation are, what your goals are, what you have available, what's your cash flow, and really try and dive in to really decide what the best looking amount of premiums going into this thing and the best policy design to maximize what you're using it for. And what that really means is just a long way of saying that each one of these policies is completely customized, completely different. Every one of them is going to be completely unique. And so whenever we design a policy, we need to know how much goes into it. There's a lot of flexibility in this too. And Chris, we should hit that too. Like if down the road, in this example, they can't put 50,000 a year in, they have an ability to really drop that down where the thing, continues to grow and be there for them. But if they aren't able to put the money in, they don't have to, and then they can make it up for it later. So there's a lot of flexibility. And so when we're designing these things, we can take future needs into account as well to build it to be flexible to match your needs. And so in this case right here, she had $150,000 sitting in her bank account, at her bank she does business with. And as we all know, money sitting in a bank account is not doing anything for you. Money in this policy now is compounding, guaranteed, tax-free for the rest of your life. So she said, well, let me just transfer the money from my traditional bank account doing nothing for me into this policy. But her thing was she wasn't ready to commit to $150,000 a year. She knew she could do $50,000 a year moving forward, but she wanted to get that larger amount in up front. So that's why you see right here in year 1, the contract premium, which we call them premium deposits because it's the money we're putting into our banking system. You can see the $150,000 going in the first year, but then $50,000 a year going in after that. Okay, we'll talk about down here after year 10 what happens in a second. But to keep this just kind of going with what Chris was talking about before, in this example on this illustration, what I did is I just showed what this looks like. Let's say if she starts using it in year 8 for doing what we call private money lending. Is that cool, Chris? Can I just kind of get into that?
Yeah, perfect.
So I know in her situation, her goal was to continue to do active real estate investing. And her and her husband had a business they were putting some money into. So she wanted for the first several years just to use it for those activities, which is great because she's using her policies. She's putting the money in there, like Chris just explained, borrowing it out, creating a return and making that split. But let me show you what this looks like after a few years. So she told me that, down the road, she wanted to start doing private money lending. So we did this quick example. So you can see in year 8 of this policy that the policy grew by $66,722. So that's that increase for the year in cash value that we just talked about. Now to get that, she had to inject $48,593 for that year's annual premium. So she put $48,594 in, and her banking system, her policy grew by $66,722. So if we do the math on that, that's an $18,129 growth that year, or another way to look at it would be 37% cash on cash return. Now remember, to get that 37% cash on cash return, all she had to do was 8 years prior change one thing, which was where her money goes first. So instead of putting that money each year into someone else's bank, a savings account, a business account, checking account, whatever the case is, she simply put that money into her own bank instead. And by doing that 8 years prior and every year they're following, in the 8th year, when she deposits the annual premium into it, it grows by 37%. That's just automatic. She doesn't have to do anything else to get that. But here, and I mean, how many of you, I guess I could ask this, how many of you would be super happy with just that return right there on your money? I mean, I know I would. Chris?
Yeah, sign me up. I'm already doing it, so you don't have to sign me up anymore.
You're signed up already, yeah. But anyways, I mean, and the kicker on all this that we haven't even really mentioned is this is tax-free growth within this policy. And so when you look at an after-tax growth, it's actually much higher. But let's just keep it simple, 37% cash on cash return that year. But remember, when the money goes in there, the money's not stuck in there. It's not like a retirement account where you can't pull it out and use it and things like that. We could take a loan against this thing like we just talked about. So in this case, what she did, she took a loan from the policy. And then this just kind of shows what that looks like. So a typical private money lending deal, 12% annual. So after we do all the math on this thing, she made 12% on her money by pulling it out and putting it into a private money lending deal. She made 37% on her money that year just by having the banking system. Now, she did pay 5% in interest that year to the banking, to the insurance company to be able to borrow that money and use it. But at the end of the day, what did she just accomplish? A 44% cash on cash return on her money for that year. So very simply put, we did nothing different except where our money went first. What would you rather make, 12% or 44%? Now, just to make sure you guys are following me on what I just explained, that bottom question right there, why do I ask it that way? What would you rather make, 12 or 44? Well, let's just think about it. If she never put her money into one of these policies and just put in somebody else's bank 8 years prior, then she went to take the money out of her bank account and lend it out, what happens? Well, as soon as she takes the money out of the traditional bank account, it's not doing anything for her. It's now gone. So she'll make the 12%, great, by doing a private money lending deal, but that's it. Remember, when we pull the money out to use it, for example, in this example, a private money lending deal, what is still happening within the policy? Well, even when we pull it out, it comes out in the form of a loan. So all of that money is still in the policy doing what? Compounding and growing, tax-free, guaranteed. And so by making that one change 8 years earlier, it allowed us in the 8th year to make a 44% return instead of a 12% return. And to take this moving forward, these gains would only get stronger and stronger and stronger every year for the rest of her life, guaranteed. Why? Because that's how these policies work. It's guaranteed tax-free growth. It's pretty cool stuff.
Absolutely. No, and I want to just hit some questions. Nick had a question here that I thought was a good one that would give a good lesson here. And folks, we're just kind of going back and forth, just kind of giving different lessons, just so you can kind of see why it is we use these specially designed whole life policies. Let's go over an example. You took 500,000. So if it's okay, we're going to do it at 200,000 because I don't want to go to the 500 on this smaller policy. 500,000 from the policy for a real estate deal. So basically you're taking a loan for a real estate deal and you didn't pay it back. So in other words, you just stole from your bank. You never paid your policy back. Okay. Which, you know, is not what we teach. Not at all. I mean, if you're going to be the bank, be an honest banker and always pay your policy back. And the second thing that it says is, you know, the policyholder, the one that owns and is the insured on the policy, dies. So policy owner took a loan, bought real estate. The real estate's operating. He didn't take the interest or the rents from the real estate and put it into the policy. He just went out and blew it, like had a fun, you know, after hobby or something. And then nothing happened with the policy. It just kept, you know, going and going and going. And then he died. So what would happen in that scenario? And we'll do it right here. All right, first thing, we got to find the year. Where do we have 200,000 cash value? Right here. So this year, which is year 8 in this policy, this is a smaller policy, we take 200 out and we buy real estate. Okay, so now we got some real estate over here. So that 200 that came out would come away from the death benefit. So right here, oh, sorry, 451. So we subtract 200,000 from the death benefit. There we go. So let's just say you got 251,000 left. This is a bad example because the death benefit dropped significantly on this one, but that's okay. We'll still use it. And then now you've got 251,000 left as the death benefit, but you got the $200,000 property. You die. The insurance company will pay a death benefit to your heirs for $251,000. Now, remember, the property was bought with a loan from your policy. So when you died, not only did they get the 251, but they also got the property. So that's basically how that would work. Look like happened when and so they would own the real estate, bought and paid for, and they would also get this residual 251. That makes sense? This does happen from time to time. I'm not going to use the person's name, but I'm just going to do an example because this is the best way I know how to teach is to draw. So you got your specially designed whole life. You're funding your premium deposits into it. And then you take loans, just use the 5.2 because that is today's interest rate. So I'm trying to keep things relevant. And you, let's just say, pay off debt. What is supposed to happen is whatever the debt's monthly payments were. So if you had, we'll just say the debt was a Visa. The Visa had a balance of, let's just use 10K, and the interest rate was 29%. So you were paying $100 a month. Keep math simple. That was your debt. You put the premium deposits in the whole life. You took a loan for $10,000. And what we did, God, I need the right color here. Here we go. We paid off the debt. Okay, so the debt is gone. What is supposed to happen is you then set up with, and we have a team that does this. We set up a loan repayment, which is a two-step process. Let me just explain how simple this is. The $100 that you used to pay for this Visa, which now you paid off with your bank's money. Your bank is now being charged 5.2%. Okay, so that's how much you're paying on that 10 grand. But you were paying 29%, so that was a good mix. 29 minus 5.2, not bad. And you know that your 10K is still earning between 5 and 6% interest and dividends, right? So you're doing good. You're feeling good. So now you're supposed to set up the same bill pay or check. I used to do this manually, but then I did bill pay. So I set up a bill pay for $100 a month. Or I just go into the Visa bill pay that I had set up and I change it from Visa, and I change Visa's name to me being the policyholder. So now all of a sudden every month $100 is paid into a bank account, which is your segregated account. And then the implementation specialist, or us or anyone, I mean, doesn't matter who it is, can get a one-page form for a loan repayment. Heck, you could even go online to your policy and you can do this all online. And you set up a $100 repayment to your policy, because why would we keep the $100 in their bank when the $100 could live in your bank? So now we take the $100 and we are now every month taking the money we gave Visa and we're now keeping it, but subtracting it from the loan. So the next month, the insurance company is charging me 5.2 on 9,900, then 98, then 97, then 96, because you're paying $100 a month back to the policy as a loan repayment, which of course is reducing the loan, which is also helping your spread. You had a spread of, 80 basis points. Every single time you pay down the loan, your spread gets bigger because this is simple interest. This is compounding interest. But what happens when somebody forgets to do this? Life happens. Okay, they forget to set up the recapture, because no matter what, this 100 is in some bank account because you no longer have to give it to Visa, so it's sitting somewhere. But we forget to put it back in the policy. Here's what happens. One time a year, this is the Monopoly board. You reach the go, and you're so happy. You get your statement right there. Dividend. Your $200 pays out. You got a dividend from the insurance company. You're like, woo, top line. But then you look a couple lines underneath, and it says loan interest due. See, the insurance companies only charge this interest, this 5.2, one time a year, and that is your policy anniversary. So now you get this bill. I don't know. Let's just say it's $5. They want $5 from you because you took a $10 loan from them at 5.2%. We'll do it the right way, 5.2, okay, 520. That 5.2%, and they said, all right, great. Now we want our interest. It's 12 months later. This should never be an issue for anybody, because we're paying 29, and now we're only paying 5.2. But the problem was we just forgot to connect the dots and finish the circle, because that's all this is, folks. A big circle. Money out, money back in. But if you forget the money back in, what has to happen is now this $5 or $5.20 needs to get paid from somewhere. So a couple things. Number one, you could go to your traditional bank, this one, okay, your bank account, and you could pay that, okay? So, or I should have just done it over here. You can pay it from your traditional bank, or you might say, oh, crap, I don't have any money in my traditional bank. Things have been rough. I don't have it. I spent that $100 that I used to give Visa. Okay, great. What the insurance company is going to do is go into your cash value. They're going to pay themselves from your cash value that was earning interest and dividends. So now the $5.20 that was owed this year will go up by or the interest you paid, $5.20, will now be more next year, because now you're paying that interest on a larger loan, because you're not paying it on to 10,000 or the declining amount. You're paying it on that plus the interest you rolled into it. So now you've got compounding almost working backwards for you, but you'd still be ahead of the curve over time. So it's not like this is going to lapse your policy, although I guess it could if you kept doing it over and over, but it would take a very, very, very long time. But we just have to remember, we have to connect the dot. So it's not the end of the world. The other thing that this is where it gets, let me explain where it gets really bad. And I've seen this happen before. Let's say you're doing this. You're not an honest banker, like we just said. Every year, you just let the interest pile onto the loan. You're not paying your loan down. You're not recapturing any money. But then one of the years, let's say you're doing your premium deposits yearly, you get your statement, okay, and it says premiums are due. Premium deposit is due. And you're like, crap, I don't have the premium deposit. I can't save the money. What happens now? Well, a couple things. Number one, a lot of times, let's just say it's $10. Let's actually do another number. I want to do it easier. Let's say your premium's $1,200. Do 12,000. That's more realistic. I like that better, right, James? Let's go with a little bigger number, 12,000 bucks. So you get your premium notice for 12 grand. You do not have it. Okay, so what are our options? Well, we can change the mode to monthly, and now it would be roughly about 1,000 bucks. So now instead of having to come up with 12 grand, which you can't, you just got your tax bill, state and federal. Property taxes fell on the same day, your water heater went, then your furnace stopped working when you tried turning it on because it's freaking cold here, and then you go out to your car and your tire's flat. I mean, we've all had those days, right? James has those every other day. I mean, come on. So you don't have the 12, but you can come up with 1,000 bucks. Great, now it's 1,000 a month, save the day. But let's just say, nope, I don't even have the $1,000. What could you do? This is where things will start to go really bad for you. So I want to be clear about this. Do not do this. If you're going to do this, your banking system is going to go out of business. There's no other way. But if it's an emergency, just a one-off thing, no big deal, just realize, look in the mirror and say, I will never do that again, ever, ever, ever. Okay? You could, if there was cash value, you could go into the cash value and use the cash value to pay the premium. You could either do it with a loan. So now all of a sudden we just increase the loan. Now instead of being $10,520, it's now $12,520, or yeah, $5.20, whatever. Just go along with it. You just added the premium onto the loan, and remember the loan's getting charged interest. So if you continue to operate your bank the same way you were before, where now you're not making the loan interest payments, so the loan interest comes, you just let that roll up because you're like, I'm not paying the loan interest. Then your next premium deposit comes in and you're like, I'm just going to use cash value. Listen, that's a fantasy world. Like, you can't do that in any institution. You can't do that at the bank. You're literally stealing from yourself. That's the scariest thing. So I'm not saying that's bad, but just don't ever do that. If you had to do it 1 year, great. Don't ever do it again. All right. Can you use a HELOC to start a policy? Yep. Good and bad. I guess it could go both ways. And then I'm going to get into the next thing. Stephen, I promised earlier in the WTF that we'd talk a little bit about tariffs and taxes. I can't give tax advice, but we can talk about what the tax plans are for the two presidents. So do you want to hit that in a second?
Yep, man.
All right. Is everybody liking this? All my new folks that just are here for the first time, put I in the chat again. Perfect. Did all that make sense for all of you folks that are brand new? I mean, was that helpful? I kind of grazed the surface. I tried showing you how we're really just playing a real life game of Monopoly. We're not just putting money in and letting it go around and collect and go. We're trying to have that money go out into workforce. Why? Because, well, math. That's why. Because compounding interest is why. And then I just tried giving examples of, okay, what happens if things get rough? And I forgot to mention one thing. Stephen, you should have called me out on that example. One thing also that I completely spaced, and I'd be mad at myself if I don't say it. Let's say that individual that had premiums of 12,000, remember they could reduce it to monthly at 1,000, but I forgot one step. This 12,000 on every policy we build is not the minimum amount. So
Yes.
in some cases, the minimum could have went down to, I don't know, 12,000. What would that be? Like $5,000, Stephen? Pretty normal, maybe even less.
3 to 5,000,
Yeah.
depending.
So you could reduce that to 3 to 5,000. And all we're doing is we're just reducing or pausing the PUA. You'd always want to add $10. So if it was 5,000, okay, was the minimum, let's just use that. You wouldn't just put 5,000 in, you'd put $5,120 because that will keep your ability to go back up to the 12,000. So now if somebody was like, I still can't afford 5,120, things are really rough, I couldn't do 1,000 a month, that would crush me. Great. What is 5,120 per month? 400 and change, right? Could you afford that? And if you can't, well, back to what I said, cash value pays premium, increases your loan, things are starting to get bad. Hopefully that made sense. And I didn't want to miss that there.
Yeah, and there was one more comment that came in pretty good. If you don't need the income coming in from the loans, do you advise paying 100% of the payments back to the policy?
No, I mean, a lot of people, that's a great question. So let's just say somebody lends 100,000 at 12%, they're getting $1,000 a month. Okay. So we'll kind of just do the math, but they know the loan. And if it's okay, folks, the loan interest rate is higher than 5. I'm just going to do it for simple math. So if you're making $1,000, okay, and $100,000 loan, that means you're paying $5,000. All right. So yeah, 433, is that what it works out to be? I think I got it, a month. All right, so you're bringing in $1,000 a month because you're making 12%. You owe $434. That's what you owe the insurance company. So what some people will do, they will take this 1,000 that they're making from the loan. They will then recapture 500 of it. Okay, and this number could be anything you want, but 500 at least is enough to cover that. So they recapture 500 and then they go out and they enjoy and live off of 600 a month. Yeah, you can do it any which way you want.
And and to your point, Chris, if you don't need that extra 600 a month,
Oh, well, then I certainly would.
yeah, put it back in the policy. Because remember, when the money's out of the policy, you're going to be charged some interest. As you get it back in, you're no longer charged that interest. So the 5% annual interest that the insurance company charges is an annual interest. So if you're paying it back throughout the year, you pay it back after 2 months, you're paying a lot less than 5%. It's only while it's out. It's not like it's not 5 points regardless. It's an annual rate. So if you don't need the money, then get it back in there because now it's in there ready for you to take another loan and use it for the next deal.
That's important. Now, in practice, folks, like every penny that I send out there in loans, I recapture back into the policy. Even if I need the money the next week, I'll still recapture it all because that's just how I'm programmed. I mean, money goes back into the policy, money gets deployed back out of the policy. So if you didn't need the $1,000 to live, yeah, all of that should go back to the policy. Eventually you'll hit a point where you can't put all of it in, but at that point you just start another policy. That's how I built up. So, all we're basically doing here, and forget all these numbers, none of it's important, is I just want you to all just do the visual. We are literally creating a circle. Remember, the one thing we always say is we show you how to take back control of your money. So we're just changing where the money goes first. We're then deploying money for all the things that we normally would do. Okay, we'll just call them opportunities. Could even an opportunity, and this is hard. People will not understand you if you explain this to them at the bar. If you say, yeah, my money's always being deployed into opportunities, things like my car out in the parking lot, they're like, whoa, car? That's not an opportunity. But for us, it is. You have to understand that. Like, I had this discussion yesterday with somebody. It was tax day, and I was bitching about the taxes. And they're like, well, maybe you shouldn't buy any Porsches this year. I'm like, the Porsches make me money. But they didn't understand that. So I said to him, okay, let me show you how this works. If the opportunity is this stupid car, okay, bad example, but that's the opportunity. And let's say the car is $1,200 a month that I recapture, but that $1,200 a month works out to be 7.43% because that's just what the bank would have charged on that loan. Now, whatever that 7.3%, let me ask you a question. Is that more than the 5.2? Yes. So does that make sense for this to be called an opportunity? It does, because I make a spread. Okay, I'm making a 2.23% spread on that. All the while, you remember the numbers we did on the illustrations? I'm still making that. So I'm not making a spread on the policy, but I'm making interest and dividends. So we showed you exactly what that interest and dividends was each year in those policies. 7, 11, Stephen's got way up there. So I'm still making that. So this is how I normally do it. This is the spread I'm counting. And then the money I make over here, that's kind of like, that's cool. My money's working 24/7, man. I don't have to work any harder. Loving it. So this is how I run it. So a car is an opportunity until you can get a car loan below the 5.2%. And then it no longer becomes an opportunity and you just kind of discount that. So a house or a loan at 12%, clearly that's a good spread. So every time you're doing this, the main part of your goal is to make sure the money makes it back into the policy. Otherwise, you lose control. If you break the circle, you allow the contagion to come in. Okay, you don't want to be in a submarine that blows aside. It's the same thing. You want your banking system to be nice and tight, and you don't want anyone else in there because you want full control of the entire process. To have full control, you must follow the whole infinite banking concept process. Infinite banking concepts process.
So back to the $500 we were recapturing from the other one. So Lynn asked, do you put that $500 into PUAs or the loan repayment? So if you could,
this one here.
But if you could just maybe build a new square, and let's just go through like each piece of the policy real fast.
Can I keep anything of this?
No, we don't need that.
All right.
Let's just clarify the different pieces of a policy.
You talk and I'll draw.
The premium, we have the base, we have the PUA. Okay, so the total premium, you can pay that monthly, quarterly, annually, but that's going to make up your premium that goes into the policy. And the premium is made up of base premium, which must go into it, which is that smaller amount that we were just talking about, like in the $12,000 example, like being able to drop it down to $3,000 to $5,000. That would be the base that continues to go in. The additional from the $5,000 to the $12,000, that's what we call PUA. Okay. So if the premium was $12,000 total, it was, let's say, $5,000 in base and $7,000 PUA.
Okay. Thanks.
And actually, let me pin you while I'm talking so they can see you drawing. Okay. All right. So that's the premium. That's what goes into the policy. That's
everybody might not know what the difference between base and PUA is.
Okay.
You want to explain that?
Yeah. I mean, real simply put, the base is what a typical whole life insurance policy premium is made of. It's the foundation of the policy. It's the primarily like the cost of insurance in the policy, and it's what provides the death benefit. And then the paid up additions, which is PUA, paid up, it's basically purchasing additional death benefit. What's the best way to explain it, Chris? PUA.
If the base is the normal whole life, that's here. Okay. This includes two things: cash value and death benefits. So think of each one of these squares, your base has two components. When we add money to PUAs, what we're doing is buying a whole bunch more of these. We're purchasing paid up additions. So these little squares, we're just buying a bunch more of them because we're shoving so much in. And each one of these little buggers has cash value and death benefit. Cash value and death benefit, each which is going to grow just like our original one. So the more money we can get increasing our cash value and our death benefit, and just so you all know, this is organic. So the cash value forces the death benefit up. You can't ever have more cash value than you do death benefit. So if we force the cash value up through paid up additions, the death benefit must rise. One thing I want to correct that you said, Stephen, is you called the base like the cost of the insurance. The base includes the cost of the insurance, but that makes people think, well, wait a second, in this, out of 12 grand, I'm throwing 5 grand away every month or every year to cost of insurance. That is not the case at all. The base part of the policy is actually the most efficient from a growth standpoint in the later years, and just super duper quick. Visuals are worth 1,000 words.
Yeah, I was going to tell you to draw a rocket ship, and that's how I always learned it.
Yeah, I was going to do that too, but I was just thinking, so in this scenario, 12 is the premium deposit, 10 is the base, right? So if here we're doing 12, so that means 2 grand's going to paid up additions, but 10,000 is the base. Once we get rid of the 2,000 to the paid up additions in year 7, that would mean, well, that there's no more extra money going in, so my policy is not going to grow. No, because you got your base, 10,260. So in this particular example, you put in 10,260 and it grows by 15,711. That's just base, folks. So you can't say the base is all cost. Now, it does have the cost for the death benefit in there, but it's not all cost, because if it was, how did 10,000 in base grow to 15,000?
Yeah, I definitely oversimplified that. What I meant is in the early years, it builds the foundation of the entire basically vehicle that we're using. And so that's why in a standard whole life policy, yes, you're going to have cash value, you're going to have growth, and you're going to be able to use it similarly, but it's probably going to take you 8, 10, 12 plus years to be able to get there. So what the PUAs do is it gets you there on day
Faster.
one, as opposed to having to wait 10 years. So if you look at a rocket ship, you know, the base is really the rocket itself, where you need that rocket to be able to get up into space, to be able to orbit the Earth or get to the moon or the Mars or whatever you want. But you need those rocket boosters to get you up into space. Now, once you're up into space, you know, there's no gravity, so you can float and drift and do everything with very little energy. It's very efficient in space. But because of the atmosphere and gravity and everything, we need those rocket boosters to get us up there. And that's exactly what's happening with this policy. The base is that rocket ship, and those PUAs are the boosters that are getting you there very, very, very quickly.
That's the best. And then when the rocket gets into space, these boosters, which did their job in the early time of that rocket taking off, or in this case, the early years of the policy, now we don't need the paid up additions because now we're in orbit and now we're efficient. So now our base is the most efficient component. So we just get rid of the boosters and we just send those suckers back down to that little plank that Elon will land it on, no problem, piece cake. If it's even off paces, we'll just grab it with the chopsticks. So I love it. So that's the best way to explain it.
All right, so
All right.
that's piece one of one of these policies. That's the
Okay.
premium. So the premium's always going to go in each year, each month, however you're paying it into it. And that premium, all of it together, is going to continue every year for the rest of your life to grow the cash value and grow the death benefit. But the cash value now, so maybe write that cash value, Chris, at the top, and then death benefit at the top, so I can explain kind of what's going on here. All right, so cash value, that amount of cash value, that's where the loans come from. Okay, so cash value is where the loans come from. Now, before I get into the cash value, when we design a policy, we have to design it within legal guidelines and legal limits. This is what's known as MEC, okay? MEC limits. These are rules set by the IRS, by the federal government that regulates life insurance policies. So MEC simply stands for Modified Endowment Contract. So basically what the law says is as long as you design this policy within those guidelines, it'll be a life insurance policy. But if you get outside of those guidelines, it converts it from a life insurance policy into a modified endowment contract. And you wouldn't want that to happen because a life insurance policy has a lot of tax advantages to it. A modified endowment contract, you basically lose a lot of those tax advantages. So we want to work within that life insurance contract guidelines and framework. And so when we design a policy, the way to make it as efficient as possible for banking purposes, which is what we're using it for, is we want to get as much premium into that thing each year, right up until that limit that the federal government tells us we're allowed to put into it. Okay, so what happens is when we're putting the premiums in each year, the premiums are basically the maximum amount we can put into that policy. And that's why you'll hear, you know, Chris, I don't know how many policies you have now. How many do you have now?
I don't know, 14 maybe?
I used to always say 9, but you're up to 14. I think
I don't
Kessler
know. With if I
like,
count babies, yeah.
pushing 30, I think Kessler said. I mean,
Yeah.
I've got a whole handful now. Like, so you keep adding policies because you can't put more into the existing policy. And I'm going to come back to that in a second to get to Lynn's question, but I just want to kind of explain that. So we build it, maxing it out for premium. Okay, so now we take a loan from the cash value. Now we use that loan to invest in a private money lending deal at 12%. Now we have that money coming into us, the interest coming into us each month that allows us to put that $500 back somewhere. So Lynn's question was, do we put the $500 into PUAs or into loan repayment? All right. So the answer to that, Lynn, is you're going to put it back into loan repayment because you're not going to be able to put it into PUAs because you're already maxed out. You've already put in the maximum amount of base and PUA for that year. Now, the caveat to that real fast is if you're paying, let's say, monthly premiums, okay? Maybe you need that $500 interest to make your monthly premiums to max out your PUAs. In that case, I'd rather see you maxing out your PUAs than paying the loan back, because I want to get that thing efficient and growing for you, and we'll worry about the loan later on. When that lending deal pays off, when you get your principal back, we'll just cover it all right then at that time. So, but if you're paying annually or whatever, you can't put more PUAs in. So that would be the loan repayment. Does that make sense, Chris?
It does. I love the way you brought that full circle, because I'm not going to lie, like there was a point where I felt probably the way you do oftentimes, like where the hell he's going down a rabbit hole. Now we're talking about mech. I'm looking over here at James. I'm like, oh my God, where's he going with this? And you brought it right back full circle and answered the question, should you repay the loan or should you put it into the PUAs? Brilliant. I couldn't have done that today. I tell you, my mind's not working fast enough. What else we got?
Let's see. I chose the annual dividend payment from the carrier to be credited towards the PUA rider. Should I still make the entire amount that I originally signed up to pay annually for the PUA, or can I just pay the difference?
Okay, I got that. So first off, let's change the terminology. And I think it changes the whole framing of that. Instead of pay, can you put deposit? Can you read that to me, Stephen? But change pay to deposit.
Okay. I chose the annual dividend deposit. Wait, yeah.
Well, yeah, that change pay to deposit.
Well, the annual dividend is technically a return of premium, but okay. So I chose the annual dividend deposit from the carrier to be credited towards the PUA rider. Should I still make the entire amount that I originally signed up to deposit annually for the PUA, or can I just deposit the difference?
Okay. So yeah, it didn't quite flow as smoothly as I thought, but I don't want people, when you think of the premium deposit, stop thinking of the premium deposit as a payment, because it's not. You're making a deposit into your bank. I don't know anybody that wants to go to the bank and make a payment, but everybody wants to go to the bank and make a deposit. So that's why we got to change up. It's a premium deposit. So then you put the money into the cash value, or the money goes into the policy, we'll call it cash value, but goes into paid up additions, which is increasing the cash value and increasing the death benefit. That's what the paid up additions are doing. Now, the paid up additions increase also your dividend. So you get the dividend. And now what you're doing is you're asking, should that dividend go to pay the deposit? Can't even say pay the deposit. Should the dividend go to help with your deposit and stop buying paid up additions? That is completely backwards. So you would really try to always avoid doing that. You'd never want your dividend going to make your premium deposit unless you were in tough financial times and had nowhere else to turn. You went through reducing down the PUAs, you went through all that stuff, and you're just like, I'm not there. Well, then you would apply the dividend to the premium deposit for a period of time, but that will stunt your growth of your banking system. Your banking system will literally not grow by much. It'll just be growing by the guaranteed interest rate. That's it. Because you've now taken dividends and you've taken them from growth to now just survival and making the deposits that you told us you wanted to be able to save. This is how much money I'm saving. So I want the ability to save. Oh, and by the way, I want the ability to lower that savings down to this level. That's my comfort, max, min. So we build it, but then if we take the dividend and we do that, now you're literally taking the growth portion of your policy away. I would try to avoid that at all costs. But again, it's easy to avoid when you change payment, because a lot of people are like, oh, I don't want to make a payment. I want to use the dividend to make the payment. I'm not going to work to make a payment. Great. It's not a payment. It's a deposit. You want to use your dividends to make your deposits? That's fine, but let's not affect the normal deposits. These are good questions. What else we got?
So pretty soon everyone will say, I love to pay bills.
That's actually not even a joke. It's not that you love to pay bills. You'll say, I love making my loan payments. Love, love, love. Oh, this car, yeah, I just bought it. Yeah, the loan payment's like $3,000 a month. And then someone does that. Is it really that much? Oh, yeah, I love making that $3,000 a month car payment. I just love it. It's literally like every time I make this car payment, my family's eating better. And the person's sitting there being like, what? Why? Well, because it's simple. The $3,000 car payment that you just gawked at saying, oh my God, you pay that much? I pay it to myself. And every time I pay it to myself, I'm making 7.3% interest, baby. Yeah. That's why I like making my car payment. Oh, and by the way, you know, that the money I paid for that car, that didn't leave my account. That's still earning interest too. So I'm making money twice. So that's why I love making my car payment. The only downside is if you couldn't make the car payment.
Yeah. All right. So Jimmy was just saying some good advice here. Never let the interest being charged by the insurance company compound. Always pay it
Yeah.
annually sooner if possible. And I would agree with that 100%.
That's really, really important to say, because yeah, that was kind of back to that original question that I was trying to kind of dodge it. You know, it's like if you get your loan interest and you don't pay the loan interest, because that is a payment. I want to be clear, that's not a deposit, that's a payment. You're paying that loan interest to the insurance company, but the insurance company already paid you interest and dividends, which depending on the year you're at, is probably more than what they just charged you. So it's kind of like I give you 50 bucks. I just gave you 50 bucks. And then you got to give me back 40. How many times you want to play that game? I give you 50 and you just give me back 40. Do you like that game? Okay, the next year, I give you 50 again, but now you only got to give me back 35. Okay? And then every year we play this game, that's how it is. You keep winning more and more. Like, what? That's how this works. Every single time that's how this works. There's a really good question that came in and I have to hit it. It was from Joe Cummings. He put it twice and I love this question and it just freaking no, here we go. Do you lease your cars to yourself for a write-off? Well, there's somebody on here, Jimmy, who's become a great confidant for us, and we talk about all sorts of ideas, and we're just in my office, and he came up with this brilliant idea. So let me just map it out for you so you guys can understand this. So all of my Porsches, my cars, are owned by a company called BYOP, okay, which is a company I fully own and operate. So BYOP owns the cars. Well, not BYOB, sorry, BYOP stands for Bring Your Own Porsche. Every one of those cars were funded with a loan from my policy. Okay, so my loan paid for those cars. BYOP pays me back for these cars. Now, we'll get to that in a second. So it makes the payment for the car back to me personally. Because remember, you got to draw a line like this. This is an entity. This is me personally. So this payment includes interest, let's just say of 6%. That's taxable 6% to me every year, just so you all know. But now what I do is I've got another company over here called Money School BYOB. I did not, please, folks, do not give me credit for this. I don't think like this from a tax standpoint, but Jimmy does. And here's what he said. So I got this company, Money School, and Money School does all these really cool YouTube and Instagram videos. And he noticed that Money School always had these Porsches, like a Porsche almost hitting me, like another Porsche driving, where we talk about how I get all the money back for the Porsche. So like all these cars are featured in all these YouTube videos. They even have stickers that say Money School BYOB on them. But Money School doesn't even own the cars, but it's almost like stealing the cars at night, going out, filming the videos, and bringing the cars back. So what he said is, he said, duh, dummy, what you should do is you should rent these cars. You could lease them too. We rent them. You should rent the cars from BYOP to Money School. And then what you should do is you should basically charge, like, and I don't know what the amounts are. One is more than the other, but let's just say one's $1,200 and one's $1,000. I think it's actually, I think it's like 13. I think it's like that. Yeah, 2,500. So I rent 2 cars to Money School this year, and I can change this every year. I can do the rental agreement as long as I can. I do it in 6 months. So now Money School is paying $2,500 back to BYOP. Now the payment for that car is probably $2,000, okay? Or for those cars, let's just say the payment's $2,000 for those cars. Money School just paid for those cars. Now, is this $2,500 car expense for these props, is that a write-off to Money School? Consult with your CPA, but I am told that this is a write-off because it is a business expense. And damn well, we are creating lots of cool content with that. But over here, does that not give me enough money to pay the loan repayments? Yep. But it actually gives me extra money. These aren't the exact numbers, but then what I'm in the process of doing right now, it's not done yet. BYOP is going to own a policy on its owner as a key man. BYOP is owned by this guy named Chris Naugle. He's kind of short. He looks bigger on YouTube, though. I met him. He's pretty short. So this guy, Chris Naugle, owns BYOP, and he's got this BYOP thing going on down here. So he sets up this policy so that now his cash value over time, let's just say it's $500 a month in this example, the extra $500 in income from the rental is paying for the policy. And over time, this cash value will be used to buy more cars that will then rent more cars to other companies like Private Money Club, which will then get more revenue coming back, which will then increase more policies. Thanks, Jimmy. We literally are doing everything I just explained. The numbers were off a little bit because there's insurance in there for the cars too, which we make sure the rent covers that. But it's super fun. And this policy is not even issued yet, but it is applied for, $2,000 a month. Was that helpful? My drawing got a little out of hand. That happens. This isn't scripted. Any other questions?
Yeah, you ever have anyone using the policy for venture capital?
Gosh, I'm sure there are people. I don't know of any now. I mean, Private Money Club is a venture capital deal for me. I use my policies. I put money into Private Money Club. I guess I'm acting as a venture capitalist, but I'm taking ownership in Private Money Club too. So yeah, why not? I don't think that's a bad idea. Just you have to outweigh the risk. See, I'm really risk averse, which is why you hear me always talking about things I'm doing for myself, like lending or buying mortgages out from the bank or buying real estate, like things that I control, because then I eliminate risk because I'm the only risk factor. So unless I can't go to work, which if I can't go to work, I got a really good disability policy. So I've pretty much insured my whole life, not just my life.
Let me ask, what if they get $250 million from a trust? How are they using this program if they have no debt and don't want to pay a lot of taxes?
That's a great question. So we haven't had anybody with 250 million, but in the millions for sure, from all sorts of different things. So you would build this into the planning. We would work typically with that. If somebody had $250 million, we'd probably be working with someone in their family office, and we would be devising a strategy, a private banking strategy for them. And that private banking strategy would be used to fund that family office's investment endeavors, which almost always include real estate because of the tax advantages for the wealthy family. And I would say anyone with $250 million, you're a wealthy family, you got trust planning. I already know kind of where you're at least basically. Your family office is who we're going to be talking to. We're very rarely going to be talking to the owner of $250 million. And if we're talking to the owner, that owner is very quickly going to put us off to their CPA and then their team. But hypothetically, if somebody did just have $250 million, book a call with us and we'll show you exactly how we do it with other folks in that same situation, of which we have quite a few of them.
And then just one suggestion that we can get in the last 5 minutes into the tariffs and taxes if you want. But
yeah,
Jimmy was just suggesting, and I think this kind of comes from the Nashville event a little bit, but we'd love to see some of Craig's spreadsheets where he compares traditional versus, using a banking system and those examples, but have you delivering it play by play. So having it on the screen, but you actually doing it.
I will. And that was literally our very first run through with that. It was a bit dry, a lot of numbers. And we were already talking about how I can cut out probably 70% of that stuff and just present it and just to get to the solution. So we will be doing that. I just haven't had time to unpack that one yet.
Awesome. All right.
Right now. So here we go. So I'm going to actually show you folks some things. So we're going to talk a little bit about tariffs. Does everybody understand how a tariff works? So I did this earlier in WTF. I'm not going to make it very difficult, but up here in Buffalo, we're very familiar because we have this other country called Canada. Now, some of you maybe know what Canada is. The rest of you just think it's Alaska or that ice cap at the top. No, it's actually a country called Canada before you get there. But, the cool thing about US and Canada, because how far are we? 15 minutes from there? All right, it's a 30-minute drive. But we know if I go over the bridge, it kind of does look like this. And then you got Niagara Falls back there in the background. If I go over the bridge and I want to buy something, alcohol, we're going to use that, okay? I want to buy some bourbon. Why? Because over here, this bottle of bourbon is $1,000 in the US, but it's only $800 in Canada, okay? So it's a $200 savings. But let's just say $1 of our money here is worth $1.50 over there. So number one, I can go from the US to Canada in 30 minutes. I save $200. How many of you think a 30-minute or 1 hour round trip drive would be worth $200 for you? Most people would say yes. Okay, so I'm going to save $200 here, but then I've got, for every dollar I spend, I got $1.50. So now how much did I save? 800 divided by $1.50, 533. Okay. So now by me going to Canada, I have the potential to save $733. But is that really how it works? If you lie, I go over here, I get my bottle. The $200 savings is great, but then the 533, I come back across the bridge, I get stopped in this long line. There's this thing right here. They ask, do you have anything to declare? To which I say, yes, I bought a bottle of vodka. Great. Have you drank any of it? No, not yet. Can't wait to get home to drink that in my cozy little house without car keys in my hand or in the car. The guys in the back are drinking it, if you want to know. Okay, great. So then they say, can I have the receipt? They take the receipt. They see the difference. They charge a duty tax. Stephen, what is duty? It's the same thing as a tariff, in other words.
That's a tax. I mean,
tax. It's basically a tariff. So the same thing happens if we do this with China. So we do the same thing with China. Let's just keep all the numbers exactly the same. Although it does not take 30 minutes to get to China, and there are no bridges, as far as I know, that go from US to China. So we're going to be taking a boat, and that boat has a captain which charges a lot. There's our boat. All right, so same exact thing happens, but now all of a sudden, Donald Trump, in his ultimate wisdom, says, I'm going to tax or put a tariff on China. I'm going after China, and I'm going to put a tariff of 60%. So every bottle of bourbon that we buy from China, there's going to be a tariff of 60%. Now, I'm not going to do the math, but let's just do it here. Okay, discount bottle, discounted price, okay, minus currency exchange, just like I showed with that. Now, all of a sudden, we got to tack back on 60%. Now, all of a sudden, it doesn't look like such a good deal. So why is that? And oh, I forgot to say it. Who pays the tariff? Does everybody know who pays the tariff? Is it China? Is it when China ships the goods from their port, like they got to pay the tax? No, no, no. We do. Just like that duty, we pay the tax. And if I am buying bourbon to sell in my let's say I've got a really cool liquor store, and I don't know how to draw a liquor store, but this is kind of how I would know them to be there. And they usually have like fence and grids and windows with fences and grids. So there's my liquor store. So this liquor store is buying bourbon from a distributor that gets it from China. Now, all of a sudden, this person here that owns this little rinky-dinky Drinks Are Us, okay, that's the name of my liquor store, Drinks Are Us, we now have a 60% tariff that we have to pay because our distributor paid 60% more, and now we're going to have to pay that 60% more. So now, is that bottle of bourbon going to still sell for the same price? Nope. The price must go up or the profit must go down of my liquor store. How many of you think that's a really cool thing? How many of you now want tariffs? You guys can put I in the chat if you don't want tariffs, or put no if you don't want tariffs and put yes if we do. Christy, I already like you. Why do we want tariffs? It makes the bottle of liquor more expensive for you. It makes everything more expensive for you. Why do you want that? Stephen, are we getting any good answers?
buy American instead.
Yeah, right. That's what we're trying to get to here. So China is not our friend. They're no ifs, ands, or buts about it. They are an enemy. Always have been. So in this scenario, by us buying from China, the CCP runs China, which is a communist party. So now the Communist Party, like just about all communist parties, they benefit from the company that made the bourbon. Somehow they're connected. They're pretty much partners in most business in China. So now when we buy that bourbon, we are supporting the CCP. What does the CCP want? Control of who? The world. What else? They want money. And what else do they want? They want us to fall because they want to be the world power that they once were when they were the dynasty. So by us buying goods and services, we are literally funding the CCP, but it gets even better. We are buying goods and services from manufacturers in China controlled by the CCP, which means the US manufacturer of this, okay? They couldn't build it as cheap. This is Bourbons Are Us, okay? BR Us, and they make bourbon. This is a US manufacturer. They cannot compete with the cheap labor in China. So this Drinks Are Us store keeps buying it from China. But now 60% tariff comes in. This Drinks Are Us says, shit, I didn't know Bourbons Are Us was down the street. Yeah, it's a little bit more expensive, but it's about the same now because the cost went up on the Chinese goods because of the tariff. So now I'm going to get cool with this person down the street who's a US manufacturer of bourbon, and I'm going to buy the same bourbon from them, and I'm going to get it shipped quicker. So I'm going to have my goods faster, and I'm going to know I'm supporting US because this company hired my brother. So the Drinks Are Us owner has a brother, and the brother just got a job at Bourbons Are Us because Drinks Are Us is buying more bourbon, so they needed another guy. They hired his brother. Now his brother is coming into Drinks Are Us and buying bourbon, and round we go. And the economy starts to get better. But what was the cost? The initial shock and sticker cost of the cost going up of the goods. But the end result, proven by history, will always be business slowly will move back over to US soil. They will hire more people. The economy will start to improve. I don't need to give an economics lesson. You can determine whether tariffs are good or bad. They're bad for price, but they're good for the United States. If you believe in the United States, then that wouldn't be a problem. If not, I mean, you can always go over to China. I don't know what it takes to get citizenship there, but it's probably not too hard. Sign everything over to the CCP.
We can ask the vice presidential nominee. He's been there quite a few times from what I hear.
Yeah. Oh, so then somebody asked, what's Trump's plan? Oh gosh, I'm glad you asked. Well, I didn't even talk about her plan. That's Trump's plan, but there's a lot of other things Trump's doing for the US workers. So the brother under one administration, okay, now his taxes went down. The businesses' taxes stayed where they're at. They didn't go up 40%. The AMT for the business owner here went down or stayed the same. So now all of a sudden this whole economy here that's been built because of tariffs on outside goods, our enemies' goods, that extra money that it took for all of us to buy that bourbon at a higher cost is all coming back to us in different advantages. The other thing I'm going to mention is, and I'll get political here just for a second, but I'm just going to talk fact. And I'm going to put myself in the situation because it'll probably be easier in first person. So let's just say I'm the proprietor of Drinks Are Us. I've got an incredibly profitable operation that makes lots of money and hires lots of people. I not only own Drinks Are Us, but I own Bourbons Are Us and Vodkas Are Us. And I have all these other conglomerates that hire lots of people.
Porsches Are Us.
Porsches Are Us. I mean, it's a whole Are Us franchise, except for just, I couldn't get Toys R Us. That was already taken, but I got everything else. Okay, so I own all this. I employed lots of people. Then all of a sudden, the administration changes. Actually, it doesn't. It stays the same, but they say it changes because we want change. We want no more of the 4 years that we just had, so we do the same thing. But now all of a sudden, the owner of the company, my taxes, corporate taxes go up to 28%. I'm taxed on unrealized gains because I have a lot of money. And that means because I have a lot of money, I'm taxed on unrealized gains on my huge investment portfolio and real estate portfolio because all these companies have real estate. I own them all because I fund them with my own private banking system. So I got an increase of 40% in corporate taxes. Then all of a sudden, a bunch of other things, and I can't remember all of them right now. I did a whole YouTube video on it. Taxes basically on a lot of different levels go up. Some go down. But in my tax bracket, which I make over $400,000 a year, everything goes up. To the average person looking at this, they're like, well, sucks for you, asshole. Like, you got all enough money. Like, I don't care. Like, you own all this shit. You got plenty of money. Just pay them more in taxes. Like, pay your fair share, do your part and everything else. And I'm like, okay, yeah, no worries, man. No worries. I am more than happy to pay my fair share. This year, my fair share had lots of zeros behind it. Not real proud of it, but hey, I pay my fair share. But you know what? In order for me to pay my fair share, and in order for me to pay these new higher wages, I've made a decision. Bourbons Are Us is going to move to Mexico. I'm just going to shut the factory down here, sell the building, pay the stupid unrealized tax. I'm going to build a building in Mexico. Oh yeah, and then Porsches Are Us, we're going to move that to Germany where it belonged in the first place. We're just going to move it back there. And we're going to move all of our businesses somewhere else where we're not paying a higher tax. But that means when I move all these companies or just close them down because it just doesn't make financial sense anymore, I lay off all the employees. Which the employee happened to be one of my brothers. Okay, happened to be a whole bunch of people that, you know, all these people said, I don't like Trump, so I voted for the other side. Now, all these people are unemployed, but this tax increase wasn't supposed to bother them. It didn't even mean anything to them because, like, it was for 400,000 or more, and I don't make 400,000 or more, so let that be their problem. Now all of a sudden, it becomes everybody's problem. People that didn't think it was going to be their problem are now the ones that are laid off. The person that owns all the stuff, chances are they're going to adapt. That's business. It's survival of the fittest. You're going to figure a way to do it. You're going to cut costs. You're going to cut staff. You're going to cut budgets. You're going to cut marketing. You're going to cut everything. What other choice do I have? There you go, folks. Your history lesson, your economics lesson, and I don't even know what else. So your IBC lesson. Anything else I missed there, Stephen?
No, last thing, that's kind of a funny one. It may be too difficult for me to figure this out on my own, which pause real quick. I put the 90-minute training video for IBC in the chat box. So after this, go watch that video. It's the full explanation of how all this works in great detail. Chris does an amazing job laying it out and teaching it in that video. So check that out. But here's the real question. Will my investment banker know how to help me with this?
Investment banker? No, probably not. Investment bankers, I was just on the phone with actually one of the 70th largest investment banking firms yesterday about PMC, and they understand it, they've heard about it, but they typically, like, if they know about it, it's because they use it. An investment banking house typically would not be using this because investment banking houses are still very institutionalized. So investment banking houses, their whole world usually works off of institutions like investment banking conglomerates like Wells Fargo and, you know, all the big ones. Oh my God, what, Merrill Lynch, you know, the big investment firms. And so it's still institutional money. So they would typically not go this direction. Now, a family office, on the other hand, which could be equally as big as an investment banking house, a family office, which works for one or several families, 100% will know about what we talked about today. That's a really good question. But that just shows you there's a difference between institutional mind and then privatized mind. Family offices are all private.
And most investment bankers in that whole world, they really go for maximum commissions and profits and everything else. Remember, when we design these policies, we take a 60 to 80, 90% commission hit. We make 60 to 90% less commission than what a typical life insurance policy would do, because we give you all the benefits that we just talked about early on instead of having to wait 10 years. And so a lot of bigger conglomerates like that, investment bankers, you know, just simply aren't willing to do that.
Yeah. And I could have went a lot further on this. I did just do a video on tariffs, but it's really just explaining tariffs, the tax plans, and just some things that maybe people don't think. I love that somebody had commented, thank you for doing this. A lot of the, you know, the folks out there don't think of it like this, but I'm not really the smart guy in the room to be teaching this, but I mean, just look at history. Every other time that's been the case, when a president or, you know, a party is in office that is raising taxes, like every time, what happens to business? It adapts. And adapting in the past, at least, might be different going forward, was moving offshore. Remember all the factories opening up in Mexico, all the factories opening up over in China? I mean, you heard this. I mean, companies like Nike were frontline news for this shit. Like, why are they doing, they're a US company. Like Phil Knight grew up in Oregon. Why isn't he producing shoes in Oregon? Well, lots of reasons, but I mean, I'm just saying, if you increase taxes on Phil Knight's company, he's going to shift more business offshores, more than he already is. I'm not saying, like, you know, the tariffs are going to just cut business off from China. Like, very much no, but it needs to be brought into line, because the deficit between exports and imports in this country as of 2023, these are old, are $423 billion. That's how much more we import from just China than we export to China. China doesn't want our shit, but we want a lot of their shit. And I kind of get that. They can produce their own stuff at a cheaper cost. So I understand. But you got to understand what that deficit means for the future, and the future that maybe even we're not here, but the future where our kids have to take our spot. What do we want to leave our kids with? I'm not making this political. It's just like, this is just economics. Forget about politics. Economics 101, mathematics 101. I just happen to wrap a little bow tie of politics around it because we're at that point, a couple weeks. And listen, like, if taxes go up, I will have to make changes. After the tax bill I just got last night, like, that's a doozy, about 5 times what I thought it was going to be. Not all for, you know, tax increases or anything, but if that were to go up by another 40% hypothetically or whatever, man, I'm definitely cutting shit. There's no other way. So I don't know. The trade deficit built China, and good for them. Like, they were smart enough. They've been around a hell of a lot longer than us. They know a thing or two, you know, so they're playing the game. They really are. And we are just allowing the United States to lose the game. Don't take that from me. Watch Ray Dalio's videos. You will see through history and through actual fact where we're headed if we don't course correct at least a little bit. Anyway, I went way over. Stephen, thank you so much. You want to close us out and tell them about the Money Tank event?
Yes, actually, that's a great idea. So we all just had an awesome time in Nashville at the Money Multiplier Mastermind over this past weekend, and really a lot of hype about Private Money Club and all the people that are in Private Money Club. And so a lot of people asking, hey, are there still tickets available? Yes, we do still have tickets for Money Tank, which is coming up in 3 weeks in Charlotte, North Carolina. So it's going to be November 8th and 9th with a opening night on November 7th. So we're gonna do a little welcome thing November 7th from 5 to 7, I believe it is, 6 to 8. And then all day Friday, November 8th at the Charlotte Motor Speedway in the press offices there. We have a big building or a big space. Gonna have a lot of people. It's gonna be fully recorded and the rest of it. And Friday night, we got a VIP thing going on at a local restaurant. And then Saturday, again, back at Charlotte Motor Speedway, press offices for a full day of content, expert speakers, all on real estate investing, private money lending, basically just financial education. So it's gonna be a really powerful 2 days. And of course, Saturday night, we're gonna cap it off with dirt track races. So if you have a VIP ticket, we're going across the street to the dirt track races. If you've never been to a dirt track NASCAR event before, it's pretty wild, man. It's just be ready for it. It's different, but it's going to be a lot of fun. So we're really looking forward to it. It's going to be an awesome event. We have an incredible lineup of speakers, of sponsors, of just different experts we've invited to be there just to network and educate and chat the whole time. And at the end of the day, it's going to be a lot of active investors with opportunities, a lot of people that have money that are looking for opportunities, getting together, building relationships, making the magic happen. And I'm super pumped for it. So we got some different, so you can go right over. I'll put the link in the chat box. It's privatemoneyclub.com/moneytank. And you can get your tickets right there. And we do have a special going on. So if you buy a ticket, when you go to the checkout page, it should allow you to add a guest for a big discount. So you can basically buy one and bring somebody with you for almost free. So it's going to be a lot of fun. We encourage people to bring their spouses and business partners. That's why we do that. So looking forward to seeing everybody in Charlotte in 3 weeks, assuming the country's not burning down 2 days after the election.
Yeah, I think that at least will take till probably January. We'll see though. Stranger things have happened. All right. Well, with that being said, folks, thanks for joining us today. We hope to see a bunch of you soon, but more specifically, we'll see you this afternoon at 4:30 for Ask Me Anything Happy Hour. And anybody that has interest in tickets to Money Tank or information about Money Tank, jump on a call with us right there. Thanks so much. We'll see you next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.